Welcome to the Market Insight Call, where we sift through the noise to get to the signal to give you actionable advice so you can make informed decisions. That was hard without saying weekly today, Chris. We are moving to a bi-weekly, so every other week we will be doing the Market Insight Call. And joining me today, as always, is Chris Ahrens, Portfolio Manager with Gatewood Wealth Solutions. And why don't we jump right into it, Chris? Yeah. Let's talk about technicals and what we're seeing in the market on our price point chart.
Yeah, so there's a lot going on this week. 170 S&P 500 companies are reporting. We get a Fed meeting today, GDP first look tomorrow on Thursday, and then Friday PCE inflation numbers will come out. So there's a lot going on. Hard to really take a short-term trade, so volumes are down a little bit, but we can go ahead and look at some of this price action over the last, we haven't been here for a few weeks, so going back to about June 15th, we see that bottom was really put in at 36.66, and a pretty strong rally off of that. It was not a typical rally. It was led by defensive sectors, so large cap, utilities, staples, healthcare, small cap lagged. So a little bit of that got faded. We traded sideways, and more recently, what's probably the most interesting is the last 2 weeks is really more of what a typical bottom would look like. Really, cyclicals are rebounding, rallying strong. So is technology. Small cap growth has been really strong. That's more typical of what you'd see when a bottom's being put in. So the question really comes to is this a sustained rally, or will it be a dead cat bounce?
Right.
And looking at it, the earnings have come in, they're okay. Not a whole lot of pessimism. So really, it looks to me like the market's pricing in kind of a soft landing in the economy, and with the S&P at 3,900 to 4,000, really not pricing in recession.
So, and just to kind of summarize, it's really been an odd rebound off of that 3,600. Wouldn't say we're in the clear because there hasn't been anything really definitive, but it doesn't look bad either. We had that, like you said, trading range where a lot of the defensive stocks were rallying, but over the last week, we've seen those growth names, kind of what typically leads us out of a bear market, starting to get traction. But you said the R word. And I've noticed that's in the headline a lot. The question of what is a recession at this point, because the numbers are starting to look soft and there's serious concern, where a lot of people are saying, hey, the idea of 2 down quarters of GDP, that's really not what a recession is. Well, I would say first, what that tells me is we've already had 1 quarter of negative GDP. It's probably likely we're going to have a second. And there's certainly politics around that. We have a White House press release saying, hey, hold on, 2 negative quarters isn't a recession. But I've also seen Brian Westbury. He's also very followed on Twitter, and he's saying this isn't a recession. This isn't a definition of a recession. I've been an economist for 40 years. It's been a general rule of thumb that's been set for quite some time. But Westbury is also not on the left. It's that he's, in my opinion, said that there's not going to be a recession. So what then is a recession? And there's actually an institution that is tasked with saying, hey, this is the recession, this is what it began, and this is what we look at. And if we look at their definitions, a significant decline in the economy, and it's spread over more than a few months, and it's visible in real GDP, real income, employment, industrial production, and wholesale retail sales. So the question is what does that data look like? And I'm going to jump right into, go ahead.
Probably first defining GDP, because that matters. So that's just the measure of final goods and services produced in the economy, so domestically and in the U.S. And an alternative measure is GDI, gross domestic income. So you can either measure what's produced or all the incomes that are received. And if you go back historically, they track very similarly, and they should, because they're trying to measure the same way, just a little bit differently, a little bit of a lag. The BEA even says they prefer the GDP measure. They think it may be a little bit more accurate, but GDI was positive for the first quarter, while GDP was negative. So just something where if we do see another negative GDP print, I expect the White House to release something looking at GDI, not GDP.
Absolutely. You want to definitely shift it. But I think a lot of the concern is, one, we're, by the general rule of thumb, we're already halfway to the recession. And then if we're looking at the Federal Reserve Bank of Atlanta, they have real-time data, and they're trying to project what will the GDP come at, and they're saying, hey, another negative quarter. Now, we've been talking with an economist that we use out of Florida, And he's been saying he doesn't think that it's going to be negative. He thinks that the service, so basically a lot of the things that we were buying while we're at work from home and living at home, a lot of this consumer discretionary, that's getting replaced by service, by vacation, and he thinks that's going to offset that, maybe why some of this number, real-time data, doesn't look as positive. To me, as much hay is being made about 2 quarters of a recession tells me that those that probably have an idea of what the numbers will actually look like is tomorrow morning, I'm not going to be surprised to see a slight negative for the quarter on GDP.
But that really leads to the question is, what does that mean? What does that mean for the stock market? The stock market's forward-looking. It's looking on how do we get out of recession. Do you think this matters? I mean, it's a 1-month lag data from the quarter anyway. How are you approaching the way it's going to affect the stock market?
So other than we're a business itself, it's like we're not so concerned about the broader economy. We're much more interested in the market. And the market is a leading indicator. So it is projecting that there is a possibility that we're moving into recession because the market is down in bear territory. That's what it's producing. So that's our focus here, is to really to try to understand what is the market going to do, what is its pricing in, is it priced correctly for a recession, what are areas that may be mispriced so that we can help our clients become and remain financially self-reliant by positioning the portfolios. But to do that, we got to start looking at the data, right? So from that, we can see that, well, there has been a slight decline in real GDP, at least in the first quarter, possibly the second. Probably if you add them together, because it's not going to be high, that in aggregate they're going to be low. But what about real income? What are the things that we can be looking elsewhere to say, is this showing us signs of trouble in the economy? And if so, what is the market pricing in? So if we look at real income, I'm going to look at it in one way. This is just median wages. We could see a big jump in 2020, mainly because of all the stimulus spending that was pumped into the economy. And since then, real wages have been decreasing. But this is just a median. It's like there's all kinds of stuff on the low end, on the high end. I would say Wall Street Journal had a great article over the weekend of really saying who's getting hit right now, and it's the upper middle class. I know everyone's just cry me a river for the upper middle class. They're struggling. They did really well in 2020, but they're feeling the pinch right now. They still have enough of their income that's got to be spent on food and gas that it's starting to pinch them. Their securities that they have, their investment portfolios, like everyone else, they're down. So they're feeling it at the moment. And why that's important is because they are a big driver on the economy, retail spending. They have discretionary income to deploy. They have the choice of either investing or consuming or doing vacations. So these are important. But if we look at another data, I'll let you take this slide.
Yeah, this is an alternative way to look at real personal income, removing transfer payments. So it's just a market-based measure, none of the government stimulus or Social Security. And it's saying what does the market produce? Because this is really going to say, well, what can they spend based off their income? And it's a big coincident indicator. So looking back at prior recessions, it starts to move down once you enter recession, and significantly moves down as the recession gets worse. And looking to if they're going to declare, like you read off the list, income's part of what they're going to say, the NBER, when they say if there's a recession, it's only showing flattening.
Right.
So I think that they may be looking at this and say no.
But being that layoffs tend to happen in the middle of the recession or later in the recession, it wouldn't be a surprise to see real income kind of be stable going into the recession.
Right.
If you saw it soaring and continue to move up, that's one thing. But we are starting to see a little bit of a flattening. Another thing that they like to look at is the industrial production. And whenever we look at those numbers, it's negative in the short term, but it's not negative in anything that's abnormal. Matter of fact, it bounces back and forth. So there's really nothing telling here. And if we look at that gray spot on the graph, we can see that during the recession, it's really towards the end of the recession that this thing significantly drops. I would call this kind of a coincidence indicator. There's nothing really leading here, and we could be going into a recession and still have industrial production up. So then the other thing is the employment, or the lagging indicator. You want to take this chart?
Right. So more recently, it did lag during lockdowns. It was very difficult. But going back historically, it's what we've been saying. It's a coincident indicator. once the economy starts struggling, that's when the layoffs start happening. Again, this is something that has been announced. We all know all these companies that are going to start laying off. A lot of hiring freezes, but according to the numbers, they added 300,000 new jobs last year,
right.
or last month, excuse me. So it is still moving up, but the expectations are not for it to continue moving up.
And one of the things that we've talked about in the investment committee is this: if we're going into a recession, we may not see a large unemployment because it's so difficult to get employees at the moment. That may not be an area that you're looking to cut. It may be elsewhere in the income statement that you're looking to cut. So it may be a recession where employment is really not affected. And then I guess we'll continue to argue about what is a recession if that's the case. Retail sales. We did get a warning shot yesterday with Walmart, and it caused the market itself to tumble off these. Anything that you read on any of the headlines that really come to your mind?
For Walmart, it was all the consumer being pinched. They're not buying the discretionary items. They're buying food. Food sales are up. That's low margin for them, but the discretionary higher margin sales are down.
And
this is the big indicator. This is about 50% of indicators for how is the economy doing right now is retail sales. And I think we have a chart that shows it's a little, it goes up, it goes down, and not only is it just leveling off, it's coming down a little bit.
Right. So what we haven't experienced is an earnings recession. And what I mean by that is, for the most part, companies are still earning the expected earnings that they've been projecting, probably some growth. We have had some big misses, but most of the companies are not missing big, and it's here or there. Whether it becomes systemic, where we see it more, I would say the Walmart's the first one that really signals that, hey, this could be more than just Snapchat. This could be Walmart retail sales, that the consumer is actually getting hit fairly hard on this. When we look at the retail sales here, it's just another way of looking at it. We see that it's choppy. It's not expanding. It's not really contracting yet either. You want to talk about some leading indicators?
Yeah, so this really just summarizes it. So the gray line is coincident indicators. There's 4 of them. We basically covered most of those. Not really coming down. That's something that comes down once you enter recession. But the leading indicators, now it's the stock market, the yield curve, credit, sentiment, those are all coming down, predicting that the economy is going to start slowing. Manufacturing's in there as well. So that's the blue line, and we can see that dipping down. And historically, you do see that before recessions. It's a pretty good indicator.
And we're starting to see a little bit of a rollover on that blue line to indicate that it is questionable on whether there's going to be a recession or not. The fact, though, that we are questioning whether it's a recession or not, and we're pointing to different things, says that it's probably not a bad recession. Because if it's a bad recession, you really don't have an argument. You'll sound very tone deaf. So I would say that so far what the data indicates is possible recession. It's certainly likely that we'll have 2 negative quarters, but nothing that the market is really pricing, or any of these leading indicators is warning a big flashing red, stay out of the market, stay away from the market at this point. But we've started this off about the market being a leading indicator. So how do we position clients' portfolios considering the possibility of the recession? And this graph is basically saying the market prices these in beforehand and will probably be near or at the bottom as the market is already beginning to rally. And whenever we start to see data that we're seeing in our technicals that say, hey, start moving a little bit out to growth, start adding a little bit of risk to the portfolio, that says that maybe we have already seen the bottom, or we're getting a low. Now we still are telling clients 3,500, 3,200. That's the point where the market valuation is at. You just take the risk. Who cares if it's going to go further down? The price is such a good price, you got to go ahead and buy the market. We're not there yet. We're starting to see positive indicators in some of our technicals. One thing, though, that's still a big red and a miss is the money supply. Money supply is now negative on growth. This is a quantitative tightening. We've been talking about this. And if we were to continue to see money supply deteriorate, despite the technicals, we would just say that's a false signal. Stay away. So we're not saying, all right, the market downturn's over. You need to invest because we're starting to see some things that look good. We want to see this stabilize and begin to move up. Now, there's a couple of ways that money is created in the system. Over the last few years, really last decade, a lot of it has been created by the Fed and their quantitative easing, where they basically go out and buy bonds by printing money to exchange those. And now that they're taking those bonds back out, they basically pull money out. But the other way is that banks loan money out. And we are starting to see that, especially as businesses are seeing inflation and saying, you know what, I can go ahead and borrow. Yeah, the interest rates are a little bit higher, but they're not as high as what we expect inflation to be. And we have talked about how the CPI may be starting to get a breather, but the way that shelter is, you could also see that inflation number continue to stay elevated for quite some time and above what interest rates are. So companies are borrowing, which is expanding the money supply. And we want to see that stabilize or actually begin to grow before we say, okay, we're probably towards the bottom. So we covered a lot here.
Yeah.
But what changes that we've discussed, what are we doing in the portfolios to really position clients for this?
So we've been saying the same thing for a few months, right? We've been adding to some defensive sectors, healthcare significantly, utilities, staples. That hasn't changed. What has changed in the last couple weeks, last week, is in major equity strategies, we have started to add a little bit of short-term treasuries from the equity portfolio, from commodities and some of the really cyclical names. So we've reduced some of those. Commodities have likely peaked. We wanted to bring those back down to more of a policy weight. We're a little overweight. And we started adding short-term treasuries, small, about 1.5%. So remove a little bit of the volatility, and the plan is really, if we keep seeing more of this slowdown, we're probably going to keep adding in that position.
So we're taking some defensive positions there where we're adding treasuries if we have a market sell-off. We're reducing commodities because, yes, they usually pop right before a recession, but if we go into a recession, they're going to sell off in a big way. But it's not just defensive. I've seen some trades that we've done that are going into that growth. Can you explain a little bit about those?
I'd call it growth focus. So we've seen a significant move in growth. Right? We don't want to chase that, but we do want to start tilting a little bit towards that in some of the longer term parts of the portfolio, as we've seen really value turnover here in the last few weeks. So we've been starting to do that. A couple exchanges within JP Morgan and a little bit in the international space where we were really probably called deep value space, did really well for us. But now we're starting to make a little bit of a change there.
So if I was to summarize the portfolio, it still leans more defensive.
Yes.
But if using the sailing analogy, we're starting to get out of this storm and starting to lift some of the sails in case we can catch that drift and start to move out. It's what we're hoping for, but we just need to see some confirmation, see that money supply begin to stabilize before we're comfortable with the risk of going in, because we're not out of the woods yet, and we'll let the headlines argue about what is or isn't a recession. We definitely have felt a slow in the broader economy, and that really is what matters to equities. Well, we hope you enjoyed the call. Please tune in 2 weeks from now. You'll always get a message from us reminding you that it's coming up. If you haven't subscribed yet, go ahead and hit that subscribe button, and if you prefer the seersucker suit over the blue suit that Chris is wearing, go ahead and hit that like button as well. We really appreciate it, and feel free to share it by hitting that arrow and sending it over to your friends. Thanks, and we'll see you in 2 weeks.